Hi everyone, most of you already know me, but for those who don't, my name is Alexander. And for the last 20 plus years of my career, I have been extracting value working for the top investment banks and hedge funds of this world. I am an MBA graduate of New York Stern School of Business. That's not it. I also got an MBA in HEC Paris, which is considered the best business school of Europe, and London School of Economics and Political Science. Why so much? Some of you will ask. Well, I figured out in order to extract value, you need to know how the world functions, how the world works. And this is why you need to get a good education all over the world, not just in the US. That way you'll understand precisely how the world functions and where the inefficiencies are. And this is what I have been doing for the last 20 plus years. I've been looking for those inefficiencies and making money on them. And this is what we'll do with you together. This is the whole project that we're launching is just for that, to extract value. We'll find the true, fair value of any asset. We'll start with stocks. Today we'll look at Nike. Their financials were out yesterday. Let's look at them closely and determine whether we can make money on any inefficiencies in this stock. Let's go. Okay, let's go. Nike. You all know the company. They do the sports stuff. Everybody wants to buy the sneakers. There are a lot of lines in Manhattan just trying to get inside the store to buy a new pair. Let's look how they're doing financially wise. We spoke to their CFO and COO and never try to value a company just by looking at the financials. You always have to speak to the people who are in charge, those who make the decisions. Nobody knows the business better than them. Nobody knows the outlook. And by talking to them, by asking them questions, you can feel when they're telling the truth, when they're being, like we say, over optimistic, or where they're purely bullshitting. You can find that out just by talking to them, looking in their eye, or looking at the Zoom screen, which happens more often now because of the pandemic. But anyways, let's look at them. I'm gonna open up their financials. What do we start from? We always start from the top line. The top line is the revenue. It's the money that the company makes that comes to their accounts by selling the goods and services. They sell mostly goods. So we need to understand the dynamics. Where does it go? Does it go up? Does it go down? Does it stay the same? Because this will tell us a lot about how the industry functions, how the company functions inside the industry, whether it's gaining market share or losing market share. Where this company is doing quite well. They made 16% year on year the last quarter. So we compare the sales they did during the last quarter with the same quarter 1 year ago. We don't compare it to the previous quarter because we don't want to have this seasonality effect. That's why we look at I'm going to move a little bit because the sun is going to be in my face. Let me just move the camera like this and move myself a little bit this way. All right, so their revenues are up 16%, which is good. Double-digit growth, as we say, mid-teens, 16%. And if we dig a little deeper, we see that direct sales are up 28%. That means they're better off selling directly than through somebody else. You heard a lot of stories of them getting rid of the third parties that they usually sold their goods through. So now they want to do it themselves, and that makes sense because their sales are better. They know how to do it much better than the people who sell a lot of other brands. And if we look at digital sales, which should be good because a lot of people stay at home. They don't want to go shopping. They don't want to get the virus. They don't want to meet other people. They want to just click the button and just buy it, get it delivered to their house. So we look at this as plus 29% compared to last year. So the company is doing good if we look at the revenues. Let's look a little bit down. Let's look at gross margin. Gross margin is how much money the company makes by selling goods per $1, basically. What are the margins inside the gross margin, not the net, not the operating margin, not the net income margin, the gross margin. This is the first thing that we look at to understand whether they're like in the expense wise, are they still keeping up the margin? And they actually are. And they're doing not bad because their margin is up 170 basis points. That means 1.7% in absolute terms, 170 basis points. I'm going to explain, like some of you will find this too like childish, but I'm going to explain some terms. I want you to better understand what we're doing, how we're figuring out the true value of an asset. But the sun is in my face, so I'm going to pause a little bit and I'm going to move. All right, much better. No more sun in my eyes. Okay, so we talked about the gross margin. It's doing pretty well. If we go down, look at the expenses. They are not doing that well. First of all, there is wage inflation. That means people need more money to go out and work. Everybody got those stimulus packages from the government, basically, that makes them earn more by not doing anything than by working. So a lot of those guys who worked on warehouses, who worked on the stores, they prefer not to work at all. They prefer to stay at home, drink beer, watch something on the TV, and they don't want to be employees of companies like Nike. So this is why you got to pay them more in order for them to come to the stores, basically, to the warehouses. So they are growing 15%. I'm just looking at the report right now. It's very easy to find. If you just type Nike 10Q, you'll get the quarterly report, you'll get all those figures. But I'm gonna do it for you, so you better understand what we're looking at and how we'll go to the bottom line, and then how we will determine the true fair value, and we'll see whether there is money to make, whether we should buy, sell, or do nothing. Let's see. So the company also needs money to sell their products. They understand that if they stop advertising, people will not buy their products more than they used to before. Well, I don't think that's really fair, but these companies got used to it, and if the other ones are doing it, maybe it makes sense. I've been studying on the MBA program, and HEC is the best business school in Europe, and they are like number one in strategy and PR. And we had this big boss from one of the like the beverages company. I'm not gonna name the company, but he was a top manager in charge of marketing, and he was bullshitting that the company needs to spend a lot in order for the people to recognize the brand, to buy their drinks. Well, I think it's bullshit, because if you got, we all know the sodas which everybody drinks, and you think that if tomorrow you will stop seeing the advertisement, they will sell less? I don't think so. If you go to any place in the world, and I've been a lot of places, like in every store you'll go to, any bar, you always find those drinks that I'm talking about. They don't need any marketing. People will ask for them themselves, and they will not like it if you don't have it. So it's not marketing, it's like the logistics that makes the difference. But in Nike, they gotta compete with all the guys in the same industry who are advertising, so that's why they gotta spend money. Let's look how much they spend on this. Well, their expenses on what they call a demand creation side. That's what they call the market. Demand create. They need to create demand. They think the demand will not be there if they stop creating it by advertising. Well, this is what grows the fastest. It grows 36% for this quarter compared to last year. And they are like the selling administrative resources. That means that the rents, the wages of the management, it grew 20%. We'll see that the revenues are growing, but the expenses are growing too. This is in line. Usually the revenues don't grow without any increase of the expenses. That doesn't happen if you look at the other companies, so I'm okay with that. All right, let's go to the bottom line now. We're gonna go there quicker, because I don't want to waste time, talking about all those items, because you'll get bored, and this is not something that will make a big difference. Let's go straight to the bottom line. The bottom line grew 23%. That means that it's the net income. It's the money, the profit, basically, the money left after we subtract all the other expenses. And then we look at a thing called diluted EPS, earnings per share. That means how much money can be attributed per share to the shareholders. If we want to be shareholders, we buy the share. By buying the share, we get the right basically to vote on distributing this money, the earnings per share we get, which is diluted. So if we look at this item, they grew 22%. More or less everything is okay. The company is performing well, because their stock is under a lot of volatility after the earnings. So I just want to explain how we look at it, so you'll better understand how other people look at it and why the volatility takes place. Cash. Now we need to look at the cash. We know that they made money. They sold they sold their products to make us a profit. We would like to get part of this profit, at least. If the company does not reinvest some of it, they should pay it out. Let's look if they have the cash to do it. First of all, it's a solvency issue. Do they have the cash to function? Well, of course they do, because they're a big company. They're a cash generating company, which is in a business by selling basically consumer goods. So there's a slight chance that something can go wrong, but still we got to check that. Their cash balance is $13.7 billion. That's what they have in their bank accounts. It's when you open your bank account, you see the number. This is the sum of the numbers they have on all their bank accounts, which is higher than last year. Last year was less. This year is 4.2 billion higher, which is good. That means they have cash. They either should invest it back in the business or they should distribute it, give it to us, the shareholders. Let's see what the company is doing. What are the only two ways that the company can return cash to the shareholders? Anybody knows? Yeah, it's just two ways, that's correct. The first one is the dividends, and the second one is the buybacks. There's not a third one, only two. Let's look at each of them. The dividends. Well, this company is really good in distributing dividends. Why do I say that? Because the last 19 consecutive years, they have been increasing the dividends that they pay out to shareholders. That means every year you get more than you got the previous year. You don't have to buy more share, you don't have to invest anything else, you just get more money out of the investment that you make. Money that is distributed, not money that is, like we have this P&L on the screen. No, it's something that you have in your pocket that you can easily get out and take out and spend. Buybacks. What is bigger, buybacks or dividends? What do you think? Well, some companies only pay dividends, some only do buybacks, and this company does both. Why do companies do that? Because the dividends are usually sticky. Once a company starts paying them out, they don't lower them. If they do, the investors don't like it. Investors want some, like a constant cash flow, and it's easier to use some financial models when a company pays out a dividend that they don't lower, at least. They keep it stable, keep the same, or they increase it. Nike increases the dividend, but they spend like 450 million. Let me check that number. I don't want to. 435 million they spend last quarter on dividends. How much did they spend on buybacks? Another form of distributing the cash to the shareholders. Well, twice as much. Not twice as much, but 742 million, more than the dividends. And they have an approved program to buy back another $9.6 billion of shares. That means you will get the money if you buy the stock. Now let's first look at the outlook, like what will happen. The company is doing good. All of their financial items are going up. The revenue, the gross margin, the bottom line. Well, in order to understand what will happen, we gotta speak to the bosses, to the CFO and CEO. That's what I told you. This is what we did. We spoke to Matt and we spoke to John. What are they saying? John, the CEO, says, demand is in all-time highs and it's gonna go up, like permanently and forever. This is what he's trying to tell us. Well, this is not true. We don't believe this. We don't think that this is really bullshitting. We think that he's just being over-optimistic. I think it's gonna be a bumpy road. There's going to be like ups and downs and during the ways along the road. So I don't think it's that simple. Giving the traditional competitors they have and new market entrants, something might go wrong. So in our model, we don't think that they're going to keep the market, grow the market share forever, because nobody can does that. You always have to split the market with somebody else. Let's look at what, and plus the inflation. Everybody's talking about inflation, wage inflation. They just started to experience the inflation, and I think they will experience problems in the next few quarters because they cannot pass it over on to the consumers. The consumers cannot pay a bigger price for their sneakers, for their sport goods, because it's not that simple, because there is competition. People will buy from somebody else if they do a similar product. They create a similar product, if they sell a similar product, which is not that expensive. So they will experience some pressures on the margins in the next few quarters. So that makes us use a conservative approach towards our model when we try to determine the true fair value. Matt Friend is the name of the CFO. He showed us a lot of figures saying that our margins will be like this, our revenues will be like this, but this is like also he needed to prove the point that his boss made, that the CEO made. So I don't think we should go deep into that. Just try to understand figure out yourself where the industry is going, who is keeping the market share. They're pretty stable, the market shares. So it's just numbers, you know. You don't have to trust the CFO and the CEO, but you gotta listen to what they're saying, whether it makes sense or not. Because some of them are really smart. Some of them can prove the point, and they are worth listening to. But some are just trying to please the investors, and usually, like, you can figure it out again just by talking to them. All right, now to the main line, to the true fair value. This is what we're here for, to determine the true fair value. This is the name of the project, the name of our channel, the name of like the show we're gonna. I hope we're gonna make it a big show. I hope a lot of you will make a lot of money like we did, because we made a lot for the last 20 plus years. Like most of the hedge funds, investment banks, asset managers, they're pretty much doing the same thing. They're looking at the companies, looking at the value, at the price of the fair price of this company, and trying to keep in the portfolios the ones with the higher expected yield, as we say. In order to count, to determine the yield, we need to determine the price. So let's do it right now. So, like, given everything that we discussed, we think that the company will grow in mid-single digits. It's not going to go up double digits like the bosses are saying, the management is saying. No, I think it's going to go up mid-single digits in the foreseeable future. So when we count that, we look at the margins will go down, I told you, because they will not pass it on to the consumer because of the inflation. Eventually they will, when the whole market will do it, but it's going to take some time. So the margins will go a little bit down. The sales, we think the sales will be there because they will continue selling via online. They will continue their direct sales to sell via third parties. So it's not a question of the sales will fall. No, I think the margins will fall, and this is why their bottom line will suffer a little bit, not that much. So now, what is the fair value? What is the fair price? How do you count it? What do you consider fair? We all know that you can make money by taking zero risk, by investing in the US government bonds. The US government can basically print the money to pay you back. It's not a question of whether they'll default or not, even given, you know, the situation we were last week. The US has the authority to issue dollars. That makes it fully risk-free. So if you invest in something else, you take on risk. The question is, how much additional return should you get on top of the risk-free rate? The risk-free rate is about 1.5. It's 1.6 at the moment. Round it up, 1.5. We don't have to be really precise here. You know, we just have to understand where the value is. 1.5. And given that this company is good in paying out the dividends for the last 19 years, consecutively increasing them, it's enough to place this company in the second tier, as we call it. We split the companies into 4 tiers, giving the probability, stability of the payments that they will make to the shareholders, the dividends and the buybacks. This company is number 2. So we want to get a return of 5.5% on top of the risk-free rate for tier 2. Tier 1 is 4.5%, tier 2 is 5.5%. So that means 1.5 plus 5.5 is 7%. 7% is what we should make in order to justify our investment into this stock. But if we take out a plain financial model and stick in the numbers that we discussed, we see that it gives us a fair price of 154.77. This is not enough to justify our investment. This will not give us a yield of 7+%. It's going to give us a lower yield. So this is why this investment is not interesting. So our recommendation is sell on rallies, as we say. If you have the stock, sell on rallies. Just put sell orders on top of the prices that you have now. Don't sell it at the market. Come on, you never do this. You know, we used to fire people that whenever we say like buy or sell an asset, and the person just clicked buy or sell, or just went to the first like market maker and did the deal, we fired him, because you have to, like, if you sell, you sell on rallies. If you buy on dips. You always should buy better than the market, sell better than the market too. So the recommendation, if you have it in your portfolio, sell it on the rallies. If you don't have it, don't do nothing. Wait for the price to drop in order to justify the expected yield. Now it's too low. It should be 7+%. So this is our recommendation. I hope we'll issue more. I mean, we'll just record the videos with more recommendations. But if you don't want to wait, if you want to get a recommendation from any stock you have in your portfolio, or if you're thinking about buying, just drop us a message. We're gonna send it to you directly. All right, guys. See you later.